Good morning, good afternoon, good evening, and welcome to Martyn Lucas Investor. That was a slightly different beginning to the show, wasn't it? I was on the wrong screen, and you couldn't get the movement. But never mind, doesn't matter. We've got the NFLX earnings about to start in just a couple of seconds from now, in just under 15 minutes, in fact. And as you can see, it was a great beat. But of course, the stock is so expensive. It's 51 times earnings. That's the problem. It's ridiculous. It doesn't make any sense. Everyone's overbought it. It's a bit like a Tesla. 51 times earnings. So when you have a stock that's 51 times earnings, it has to perform ridiculously well. It has to have amazing guidance. And of course, things can't never do that. We can't get everyone on planet Earth to buy Netflix. And then what do you do then? Who buys it after that? It's only back, it only goes down, right? You're always expecting too much, but that's the way it is. So NFLX earnings is down, even though it was a great beat. Look, it's a really good beat, an historic beat actually. Very nice. Look at the difference. Look at the beat. 4.52 per share, and it was 5.28. So I'm assuming either guidance isn't that great, or we've got investors who've priced in, they were pricing in a $20 beat or something ridiculous like that to justify the price. I don't know. At the end of the day, it's sold off. So be very, very careful. Admiring Curling. Hi, Martin. Hope you and your family are well. Yes, I'm well. Thank you very much for being here. Admiring, is lovely to have you here. So welcome to you. Indeed. So NFLX earnings, we're just a few minutes away. In fact, I'll share all the information with you as we get it. It's going to be the live earnings. So just stand by just for a few. Let me just rock my chair. There we go. That's better. I'm all centered now. That's the position. That's the chart. That's how it's looking. It went overbought. It came back up again. And this is how they'll deliver it in just 10 minutes from now. This is the earnings. Looking good, right? Like that. All right, fantastic. So NFLX earnings, for the very first time, NFLX have actually done a good thing. They've actually put a video, upcoming event, rather than just when does it go live. But tonight we've got that, which is good. I actually messaged them. They've never done it before. And I said, look, why on earth don't you have an upcoming live stream? That's what you need to do. Eric B, I've got one more silver dollar, but I'm not going to let them catch me. No, not going to let the catch the midnight rider, Eric B. Just watching what's going on over there in the extra channel tonight. The extra channel behind the scenes. This is what's going on here. You can see our family over there in the extra channel, looking around the studio, preparing for the NFLX earnings. Okay. All right. Now, if you've just tuned in, please do consider subscribing to my channel. It helps me out, and also please do tap the like button as well. My seat's not in line tonight. I need to get. There we go. That's better. For some reason, I'm all wonky. I'm all wonky tonight, but don't worry about it. I'll get it sorted. It's been one of them days today. It's been absolutely crazy. Anyway, how many people are with us? Let me know if you're in the chat. Let's have a look. We've just now hit yesterday we hit 22,000, only yesterday, 22,000. We're now 22,137. I can't believe how fast it's growing. It's accelerating all the time. And our views in the last 60 minutes are 556, which is great. For the very first time, we've cracked the Tesla algorithm. Look at that. I've got 200 views in the first 35 minutes. That's unheard of for Tesla for me. It's a massive market, and I very rarely get views on it because it's a closed market. It's very, very hard to get anyone to watch any of those. But anyway, never mind. It's really good. I'm really chuffed. Where's my gold video? Has anyone watched that yet? There's the gold. There's the gold. How to buy gold. I'm just trying to see it. Oh, there it is. There it is. Good. My members have watched it now. 35 of you. We got 300 members. So about 10% of you have seen it so far. Good stuff. Omid, don't tap the like button. Obliterate it, Omid. That's nice. Thank you. How do you think this will impact the rest of the market? It's good. Of course, let me explain. There's two sides to this. First of all, Netflix is going down. Now, Netflix is part of the S&P. So, of course, if Netflix goes down, the rest of the market goes down. That's how it works. However, they beat on earnings. So that's what the rest of the market is looking at. So on one hand, it's good. It means people are spending money. It means the businesses are growing. People have got money to spend. They're spending it on Netflix, which is good. Netflix, beat on earnings. That's good. But of course, we've got the stock going down, which makes people be fearful. But remember, how a stock trades is not how another stock trades. The concern we've got is the S&P will go down because Netflix is a part of it. And we can see that right now because if I look at my overall portfolio, we are red. But I will just say, and that's the benefit of owning the S&P, it hasn't really moved much. It's been a red day. It's been a red day today anyway. We were up slightly, but this little bit now down, it's where we were before. This really isn't anything. We were here yesterday, so this isn't a big deal at all. This isn't really Netflix doing. So I'm not too worried at all, but then that's why I invest in the S&P. I don't have the stress of all the nonsense that goes on. Anyway, Radiant, Martin, this isn't an investment question, but if you had to choose with absolutely no context, how would you choose Ryan Garcia or Devin Haney? I don't know who those people are. Sorry, if you had to choose with absolutely no context, who would you choose, Ryan Garcia or Devin Haney? I literally have no idea. Just choose one, thanks. Just choose one? I don't know who they are. I've got no idea. You might as well just say A or B. I don't know who they are. Should I know who they are? I've got no idea. They are boxers. Oh, Devin Haney. Okay, so I'm assuming then you want me to pick the winner of a fight. Is that the idea? You're betting on a fight and you want me to pick the winner. Is that what you're on for? Is that what you're doing? I reckon that's what you're doing. Sounds like he's sport betting. Yes, I think he is. So, okay, I'll go for Ryan Garcia. Ryan Garcia. There you go. It just feels right. All right, Ryan Garcia. It feels right. Flipping heck. All right, you're going to tell me now he's the blind boxer and he's got broken legs. Is that what you're going to tell me? Anyway, there you go. Ryan Garcia. I chose one. Sounds like he's yes, the fight is April the 20th. When is the conference call? The conference call is in 5 minutes. We are covering it live. You're not going to miss anything. It's about to start. You don't believe me? There it is. It's about to start in just 4 minutes from now. The Netflix earnings. Yes, you're very welcome. All right. Don't blame me if you lose all your money. I'm just saying. All right, I'm just saying. Okay. Virgin Galactic is still holding up after hours. Thursday night. It's always a big night for Virgin. Gold is up today. The S&P is down. 458 now. It's just trailing down and down and down. We're down nearly, we're down nearly 3% now. I said 10% correction. 458. The last time I bought it was 459. We're now at 458. It's $1 cheaper. Should I buy another one? No, we're obviously trending down, so we're going to wait. I don't want to be paying a margin for 3 or 4 months. 2 months is maximum, really. Okay. Thank you, Louis. You're very welcome. Martyn, things looking terrible for space. There is an email about an upcoming shareholder meeting on the 12th of June. What's that about? To approve amendments to our certificate of incorporation to effect a reverse stock split of the company's common stock at the ratio. Oh my gosh, really? Craig, could you send me that link in? Can you send me that link in? Can you send me that link in, please? I would like that link. I will make a video of that after this. That is terrible, terrible, terrible news. Already they're talking a reverse split. Unbelievable. They're driving. That's ridiculous. Way ahead. It's only been under $1 for 5 minutes. Craig, send me that source in. That is that's a nail in the coffin there. That is terrible to hear. I'm really sorry for everyone. I'm sorry for everyone. Anyway, here's behind the scenes. Someone just said they love my camera. Which camera is that? Which camera is that? I've got lots of cameras moving around tonight. We've got behind the scenes. We've got this camera. We've got the back cameras. We've got the side cameras, the ins, the outs, the ups, the downs. Which camera is that? There you go. Very, very busy we are in the studio here always. Time to go PABC. I am sorry to hear that. Reddit groups are about to panic. I was in Fisker. I know your pain. Time to get out. Already they are. So Craig, have you sent that in? Have you sent that in to me? Craig, have you sent that in to me? I would like to have that. Can you just tell me you have? That is really bad. Yeah, that's the worst news. The fact that they're saying it before they need to is just so terrible. 1 for 20. Oh, that's ridiculous. That Craig, have you sent that in? Just tell me. At the end of this, I will do it. Right, we're about to go live. Oh dear, that management haven't got a clue what they're doing. Right. 1:45. Here we go. It's Netflix earnings. Showtime, everybody. In stock news, Martyn decided when to dump, not if. Okay. That's fair enough. Was that Central Pacific? Man, that's 1, 2, 3, 3, 4. Yeah. Yeah, this is due to start now, isn't it? I was looking at that thinking 1:45. It's due to start now. Here we go.
Good afternoon and welcome to the Netflix Q1 2024 earnings interview. I'm Spencer Wong, VP of Finance, IR, and Corporate Development. Joining me today are co-CEOs Ted Sarandos and Greg Peters and CFO Spence Newman. As a reminder, we will be making forward-looking statements and actual results may vary. With that, we will now take questions that have been submitted by the analyst community, and we'll begin first with some questions about paid membership reporting and our results and forecast. So for our first question, it comes from Justin Patterson of KeyBank, and I'll direct this at Greg initially. Greg, could you please talk about the decision to stop reporting quarterly membership and ARM data in 2025? Why eliminate this? And since you said success starts with engagement, how are you thinking of expanding these disclosures?
Yeah, as we noted in the letter, we've evolved and we're going to continue to evolve, developing our revenue model and adding things like advertising and our extra member feature, things that aren't, directly connected to a number of members. We've also evolved our pricing and plans with multiple tiers, different price points across different countries. I think those price points are going to become increasingly different. So, each incremental member has a different business impact. And all of that means that historical simple math that we all did, number of members times the monthly price, is increasingly less accurate in capturing the state of the business. So this change is really motivated by wanting to focus on what we see are the key metrics that we think matter most to the business. So we're going to report and guide on revenue, on OI margin, net income, EPS, free cash flow. We'll add a new annual guidance on a revenue range to give you a little bit more of a long-term view. We'll also, we're not going to be silent on members as well. We'll periodically update when we grow and we hit certain major milestones. We'll announce those. It's just not going to be part of our regular reporting. And we want to do all of this thoughtfully and give everyone time to adjust this transition. So we're going to continue to report subscribers until Q1 of next year, which links into our next annual revenue guidance for 2025. So we think that provides some long-range continuity, and we expect that'll provide an effective bridge and transition. But ultimately, we think this is a better approach that reflects the evolution of the business, and it more matches and is consistent with how we manage internally to engagement, revenue, and profit.
Yeah, and on engagement, Greg, just a reminder, we currently report our engagement on our biannual engagement report, leading the industry in viewing transparency and granularity. And we're going to look into building on that both in granularity, which would be kind of tough. Our current report covers about 99% of the viewing on Netflix, but we'll look at the regularity in different ways that we can make it even easier to track our progress on engagement. And but importantly, why we focus on engagement is because we believe it's the single best indicator of member satisfaction with our offering. And it is a leading indicator for retention and acquisition over time. So happy members watch more, they stick around longer, they tell friends, which all grows engagement, revenue, and profit, our North Stars. And we believe that those are the measurements of success in streaming.
Great. Thank you, Ted and Greg. I'll move us along to the next question from Ben Swinburne of Morgan Stanley, who asked, 2 years ago, Netflix stopped adding members. What changes inside Netflix and or the broader industry explain the significant improvement in member growth we're seeing today, excluding the paid sharing initiative? In other words, what are you doing better today as a company than in the first half of 2022?
That's a great question. I would say the thing we're doing is we're thrilling our members. That's the thing we set out to do. Talk about why we all bounce out of bed in the morning. Look at this last quarter. 8 of the first 11 weeks of the year, we've had the #1 film on streaming. 9 of the first 11 weeks, we've had the #1 original series. And I'm talking about hits like Avatar, The Last Airbender, Griselda, Damsel, Love is Blind, Three Body Problem, all of that just in the last few months. So this consistent and dependable and expected drumbeat of hit shows, films, and games, that's the business that we're in. And that's what we have to do every day. And we have to do it all over the world. So if you think about that and how we're doing about kind of quality at scale in multiple cultures and multiple regions, I look at this last quarter, you see Fool Me Once, One Day, Gentleman, Scoop, the super buzzy Baby Reindeer, all that from the UK, all in the last few months. Berlin, Society of the Snow, Alpha Males, all from Spain and all just in the last few months. So that's been, one of those things that we just keep building and building and building on. And local unscripted, which is a fairly new initiative for us. And we're finding huge success with things like our second season of Physical 100 in Korea recently and Love is Blind Sweden. These are all kind of hard to replicate things that we keep getting better and better at every day, that we're really proud of the teams for doing that. So, and remember, engagement captures all of this. And none of that's possible without great tech and product. We need to do both.
Yeah, I think that's right. I mean, the fundamental is all those amazing series, film, games, live events. But a key component of our success and something that we're seeking to get constantly better at is that ability to find audiences for all those great titles. Part of making that happen is just the number of people who look to us for entertainment. We mentioned over 500 million people in this letter. But part of that is that product we do to effectively connect those folks with titles that they will love, which then enables us to find, the largest audiences for those titles that we think that they could get anywhere. And I think as you mentioned, Ted, this applies globally to titles from all over the world, which is super exciting. So, and then of course we seek to maximize the fandom and the impact on the conversation and the cultural zeitgeist that all those titles have. And when we do that well, that just feeds positively into that cycle as we launch new titles. So, in terms of what are we doing better, what do we do better, we seek to get better at all of those things. And if we can make that whole flywheel spin a little bit faster, then that's great for our members, it's great for our titles, and it's great for our creators.
Thank you, Ted and Greg. Moving us along, we have Barton Crockett from Rosenblatt, who has a question about our revenue guidance. So I will direct this question to Spence. Spence, can you please explain what drives the revenue deceleration for the full year? So 13 to 15% revenue growth for the full year, compared with the 15 to 16% growth in the first and second quarters of this year. Secondly, he also has a question about second quarter subscriber growth. Will that be higher or lower than Q2 of 2023?
All right, sure. Well, thanks for the question. So first, regarding revenue growth overall, full year outlook, I feel really good about where we are in our growth outlook. So I just want to be clear about that. We've done a lot of hard work over the past 18 months or so to re-accelerate the business and re-accelerate revenue through combination of improving our core service, which Greg and Ted just talked about, and rolling out paid sharing, launching our ads business, and that re-acceleration really started in the back half of 23, and it built through the year. So our growth in the back half of 24 is really kind of comping off of those harder comps. And at the high end of our revenue forecast, our growth in the second half is consistent with our growth in the first half, even with those tougher comps. And it's still early in the year. We still got a lot to execute against. We also, as you see in our letter, there's been some FX that with the strengthening dollar, that's a bit of a headwind. So we'll see where that goes throughout the year. But we're guiding a healthy double-digit revenue growth for the full year, which is what we set out to deliver, and that's what's reflected in the range. And I guess maybe it's in the question, I guess, seated in this is a little bit of like what's really kind of the outlook for our growth of the business, not just the back half of this year, but into 25. And it's too early to provide real specific guidance, but we're going to work hard to sustain healthy double-digit revenue growth for our business. And we really like the kind of the opportunity ahead of us. We're so small in every aspect. We're only 6% roughly of our revenue opportunity. We're less than 10% of TV share in every country in which we operate. There's still hundreds of millions of homes that are not Netflix members, and we're just getting started on advertising. So the key is to, as you just heard from Greg and Ted, continually improve our service, drive more engagement, more member value. As we do that, we'll have more members. We'll be able to occasionally price in that value, and also have a big, highly engaged audience for advertisers. So more to come on 25 guidance, but we feel good about the outlook. And then I guess the second part of the question, I'm trying to remember, Spencer.
I'll be the bad guy on this one, Spencer. The second question was, do you expect Q2 subscriber growth to be higher or lower than Q2 of the prior year? So Barton, as you know, we don't give formal subscriber guidance. We did give an indication in the letter for you that we expect fairly typical seasonality. So paid net ads in Q2 of this year will be lower than Q1 of this year. And that's the limit of the color we'll provide there.
Thanks,
but to follow, no problem, Spence. So to follow up on the revenue guidance question, we have Jason Helfstein from Oppenheimer, who's asking for some more color on the drivers of the full year revenue guidance with respect to subscriber growth versus ARM growth, and how those two dynamics will play into the revenue forecast, Spence.
Yeah, you want me to take this one as well?
Yeah.
Okay, I'll jump in. Others can chime in as well. But when you think about the outlook for the year, it's in terms of the mix of revenue growth, it's kind of pretty similar to, we expect it'll be pretty similar to what you see in Q1, where it's primarily driven by member growth because of the kind of the full year impact of paid sharing rolling through the year, and continued strong acquisition and retention trends. But we are seeing some ARM growth as well. We saw it in Q1, about 1% on a reported basis, 4% FX neutral. And I just want to be clear, what's happening is that with ARM is price changes are going well. And that's why we're seeing those strong acquisition retention trends, because it's testament to the strength of our slate, the overall improvement in the value of our service. But we've only really changed prices in a few big markets, and that was US, UK, France late last year, and only on some of the plan tiers in those markets, not even all the plan tiers. And since then, it's been mostly pretty small countries other than Argentina. And in Argentina, as you can see, we're sort of pricing into the local currency devaluation. And you see that in the difference between FX neutral and reported growth in Q1. So mostly what you're seeing in our growth profile this year is the fact that we haven't taken pricing in most countries for the past 2 years, really. And we also have some ARM kind of headwinds in the near term that you see in Q1. You'll probably see throughout most of this year, which is that, one, we have this planned mix shift as we roll out paid sharing. So while it's highly revenue accretive, as you can see in our numbers and our reported growth, strong reported growth in Q1 and outlook for the year, that growth, as we spin off into new paid memberships, they tend to spin off into a mix of plan tiers that's a little bit of a lower price skew than what we see in our tenured members. And we're also growing our ads tier at a nice clip, as you've seen, and I'm sure we'll talk about. And monetization is lagging growth there. I'm sure we'll talk about that a bit as well. We also have some country mix shifts. So that whole combination of factors results in pretty modest ARM growth, still some ARM growth, but pretty modest in Q1 and probably throughout the year. But again, the key there is that, this is all, we're kind of managing this business transition in a way that's really healthy for overall revenue growth, as you see with 15% reported revenue growth in the quarter, strong outlook for the year. And we're building into a much more kind of durable and healthy foundation for revenue growth going forward across a larger base of paid members and a really kind of strong and scaled, highly engaged audience to build into our advertising over time, and a strong paid sharing solution, and also to kind of penetrate into those households. So we'll increasingly kind of see that mix in our revenue growth, and we start to see some of it this year.
Great. Spence, the next question comes from Kannan Venkateshwar from Barclays, and it's for you, which is, do you expect margin growth trajectory to continue being on the present path for a few years? Can you attain margins that are comparable to legacy media margins?
Well, thanks, Kannan. And our focus is on sustaining healthy revenue growth and growing margins each year. That's what we talk about a lot. We also talk about in the letter. And we feel good about what we've been delivering. 21% margins last year, that's up from 18% in the year before. And now we're targeting 25% this year, which is up a tick from the start of the year when we were guiding to 24%. So I'd say just like we have in the past, we'll take a disciplined approach to balancing margin improvement with investing into our growth. We've managed that balance historically pretty well, growing content investment, growing profit margin, and growing cash flow. You should expect we'll continue to do that, but the amount of annual margin expansion in any given year could bounce around a bit with FX and other investment opportunities. But again, we're committed to grow margin each year, and we see a lot of runway to continue to grow profit and profit margin over the long term.
Thank you, Spence. Our next question comes from Alan Gould of Loop Capital. Which inning are we in with respect to enforcing paid sharing? 2 years ago, you said 100 million subscribers were sharing passwords with 30 million in UCAN. How many do you estimate still borrow passwords? And I'll turn the floor over to Greg to answer that question.
Yeah, as we mentioned last quarter, we're at the point where we've operationalized the paid sharing work. So this is just now part of that standard mechanism that we've been building.
Time for another stock review
to translate more entertainment value and great film series, games, live events into revenue. And like we do with all of the significant parts of our product experience, we're iterating on that, testing it, improving it continually. So rather than thinking beyond specific cohorts or specific numbers, we really think about this more as developing more mechanisms, more effective ways to convert folks who are interacting with us, whether they be borrowers or folks that were members before that are coming back. We call them rejoiners, or folks that have never been a Netflix member. So we want to find the right call to action, the right offer, the right nudge at the right time to get them to convert. And just to be clear, we still see opportunities to improve this process. We've got line of sight on several improvements to this value translation mechanism that we expect will deliver and contribute to business growth for the next several quarters to come. But I also very much believe that just like for the last 15 years, we've always found something to improve in this process. And even beyond those, for years and decades to come, we'll be working on this and making it better and better and better. So all of those improvements should allow us to effectively get more of that 500 million plus smart TV households to sign up and become members. Spence mentioned hundreds of millions yet to come. This is a way to effectively get at more of those folks and make them part of our membership base. And as we mentioned earlier on the call too, I think worth noting that while we're fully anticipating continuing to grow subs, the overall business growth now has extra levers and extra drivers like plan optimization, including things like extra members, ads revenue, pricing into more value, which is important. So those levers are also an increasingly important part of our growth model as well.
Great. I'll move us on now to a series of questions around advertising. The first of which comes from Doug Anmuth of JP Morgan. What are the most important drivers of scaling your ad tier when you think about adjustments you could make to pricing and plans, partner bundles, and marketing? How do you get people over the hump for that a few minutes of ads an hour can still be a very good experience at the right price? Greg, why don't you take that one?
Yeah, all the things mentioned in the question matter. And I would say we're generally taking our entire playbook, everything that we've learned about how do you grow members, and we're applying it to our ads tier now. So clearly that means partner channels, it means device integrations, bundles, integrated payments. Those are all important tools for growth, just as they are and will continue to be in our non-ads offering. Increasing awareness of the quality of our ads experience, especially relative to the linear TV ads experience, which in many countries is really quite poor. That's an important iterative tool. When we talk about sort of marketing and awareness building, that's going to be part of our growth mechanism. Low price, that's important to consumers. $6.99 is an example in the United States for multiple streams, full HD downloads. We think that's a great entertainment value, especially at the industry-leading low ad load that we've got. So that's critical as well. So I think you can see the results of leveraging all of these mechanisms and more, and how our ads tier has been scaling over the last couple of quarters. So we're 65% up quarter to quarter this last quarter. That's after 2 quarters of about 70% quarter over quarter growth. For me, it's exciting to see that growth rate stay high, even as we've grown the base so much, because obviously the numbers indicate that means that there's more absolute additions each quarter. So we're making good progress there. But look, we've got much, much more to do in terms of scaling. We've got more to do in terms of effective go-to-market, more technical features, more ads products. There's, plenty of work ahead for us on ads.
Great, Greg. Our next question on advertising comes from Rich Greenfield of Lightshed. He has a 3-part question. Part 1, can you update us on your thinking around the optimal spread between the ad tier and the ad-free tier? Secondly, is your advertising ARPU, excluding the subscription fee, up meaningfully versus your original comments that it was in the $8 to $9 range last year? And then lastly, can you give us a sense of what ARPU would look like if supply was not outstripping demand?
Okay, I'll take the first one and then maybe hand the ARPU/ARM points to Spence. We don't have a fixed a priori position on sort of the optimal pricing spread. And much like we've done with price changes in general, we really use signals from our customers, things like plan take rate, conversion rates, churn, to guide us along an iterative path to get to that right pricing. And I think it's also probably worth noting that sort of right pricing is not really a static position. As we continue to evolve and improve our offering, that's going to change as well. But I think a good general guideline for us in the long term is that it would be healthy for us to land overall monetization between our ads and non-ads offerings in roughly an equivalent position. So that really comes down to, what works best for any given member. And it's really a member choice about which plan they think serves them the best. And then I'll hand it over to Spence on ARM questions.
Sure. No, thanks, Greg. So in terms of ARM and your question, Rich, in terms of how we're doing now relative to what we discussed when we first launched the business, as Greg said, we've been growing our inventory at quite a fast clip. And so monetization hasn't fully kept up with that growth and scale and inventory, as we're still early in building out our sales capabilities and our ad products. But that is an opportunity for us because we're still a very premium content environment, a very highly engaged audience that's at an increasing scale. So our CPMs remain strong, and we're building out our capabilities, as Greg talked about. So the revenue is going to follow engagement over time, and it's already kind of growing nicely, which is great, just off a small base. So then really, as Greg said, what that means for ARM is right now it is a bit of a drag on our ARM because of we're kind of under monetizing relative to supply. But over time, we expect to be similar in revenue on our ads tier, a combination of subscription as well as ads revenue with those kind of non-ads offerings. So that's how to think about it, but we're building to it over time.
Great. Last question on advertising comes from John Hoodlick at UBS. How are you approaching this year's upfronts, and do you believe the base of ad-supported users is now of the scale that upfront commitments can drive a meaningful change in advertising revenue and be a contributor to ARM growth in 2025? So perhaps, Ted, maybe you could start, and then Greg follow after that.
Yeah, of course. Look, first and foremost, this is our second upfronts. We're really excited to go and share with advertisers this incredible slate that we're very, very proud of. So they're going to get a look at some of the shows that are upcoming right away, like brand new seasons of Bridgerton and Sweet Tooth and the 90s Show. Some of our big unscripted events upcoming, like our Tom Brady roast, by way of example, and brand new shows like Dead Boy Detectives and Shane Gillis's new show Tires, Eric, a great new limited series out of the UK with Benedict Cumberbatch that we're super excited about. And then they'll even get a longer look at what's coming up in the second half of the year, which is, again, returning seasons of Cobra Kai, Emily in Paris, The Night Agent, Outer Banks, and Squid Game, our big one. And a brand new season of Monsters from Ryan Murphy, which is the Lyle and Eric Menendez story this year, which is going to be really incredible thing to share with our advertisers. And brand new original series and limited series like American Primeval from Pete Berg, Heartburn with an all-star cast, Nicole Kidman and Liev Schreiber, Senna, which is this great limited series on the great Brazilian Formula One driver that we're really excited about. And also I look at our movies coming up that we'll end the year with like Eddie Murphy in his most iconic role, Axel Foley in Beverly Hills Cop Axel Foley. Carry On, a big new animated feature, Spellbound. So we've got a lot of entertainment in store for the audience at the upfronts.
Yeah, I think this is an opportunity to re-engage with advertisers and look at the fundamentals of what our offering is. I mean, first and foremost, it's an incredible list of titles that brands want to be connected with. It's just super exciting to hear that roster. We've got great engagement from our members on our ads tier. We've got an opportunity to grow that even further. We think that's connected again to the power of those titles. We're rapidly growing scale, as we mentioned. That's the number one request we've had from advertisers, so that's exciting. We're making progress on technical features like measurement, on ads products, so we're excited to get that out there. And really, this is just an opportunity to bring all of that progress in a package to advertisers. And of course, to get input from them, because we know that they're going to have comments and they're going to have things that they're going to want us to continue to work on. And then really just to continue that journey, because we know there's plenty more to go do to realize the potential we have in this space. And so I would say, we're continuing to grow here. We're growing off of a relatively small base in terms of the impact against an already big and substantial business. So even though it's growing quite quickly, it takes a while to grow that into the point where it's material. So we look forward to that increasing in 25 and then, increasing further 26 and beyond.
Great. I'll now transition us to several questions around content. And this first one, I'll direct to Ted. It's a rare question around why don't we spend more? Given what seems like a very favorable current backdrop for Netflix to acquire and license content, why not lean in even more aggressively? Could it make sense to spend more than $17 billion in cash content this year?
Yeah, independent of the availability of licensed content, you should look at it. I think we've always been very disciplined about the way we invest in the business and how we grow it. And we can get a lot of bang for our buck by spending our money well and producing our shows really well, and also by acquiring the right content. And the floodgates have opened a little more on licensing for sure. But again, we're very focused on the ones that we think will drive the business. So I think we're at our current level of spending and our current level rate of growth that we're pretty comfortable spending just behind that anticipated rate of growth.
And Ted, Jason Helfstein's follow-up is also about licensed content or second-run content. And his question is, how would more second-run licensing impact your margins and free cash flow?
Well, the budget is the budget, so it's all part of how we spend against the content and the free cash flow economics. We've gotten pretty close in our cash flow against P&L on our content spend generally. So I don't think it would have very much impact on that. Unless you want to add some color to that, Spence.
I just love you talking about the discipline on our content budgets, Ted. It makes me happy. No, I agree with all of it. I mean, yeah, we spend into the opportunity, but with, I think, prudent constraints and discipline. And to be clear, like there, as you say, there has been more licensed content opportunity, but the vast majority of our content spend is still into original programming. It is and is likely to continue to be. So we'll always complement it with great licensed content for that variety and quality for our members. But the original content is still our future too.
Yeah.
Great. Next question is from Michael Morris of Guggenheim. Specific about the Jake Paul-Mike Tyson fight. For Ted, what are the characteristics of the upcoming Jake Paul-Mike Tyson fight that make this the type of sports programming you're interested in investing in? How does that content benefit your member base and advertising growth goals?
Yeah, so we're in the very early days of developing our live programming. And I would look at this as an expansion of the types of content we offer, the way we expanded to film and unscripted and animation and most recently games. On-demand and streaming have been unbelievable for consumer choice and control, and it's really put the controls of television back in the hands of consumers, which has been really phenomenal. But there's also something incredibly magic about folks gathering around the TV together in the living room to watch something all at the same time. We believe that these kind of eventized cultural moments, like the Jake Paul and Mike Tyson fight, are just that kind of television that we want to be part of winning over those moments with our members as well. So that for me is the excitement part of this. We have beyond the fight itself, we have several nights of live comedy coming from the Netflix is a Joke Festival next month. And it's starting in January. We've got 52 weeks of live sports with WWE Raw. That's going to be coming to our members every week on Netflix. And we think it's going to be a real value add to watch those things in real time. And we're going to continue to try a lot of new things. But the core of it is do our members love it? And judging from the early excitement around the Jake Paul-Mike Tyson fight, there's going to be a lot of people waking up in the middle of the night all over the world to watch this fight in real time.
I think worth noting that, just as what's relevant to members in terms of these, large cultural events that Ted talks about, that's what has relevance to advertisers as well. So it's an opportunity for us to expand our advertising offering and give those brands access to these kind of culture defining moments.
Thanks, Ted and Greg. And I'm personally looking forward to that event, and my money is on Iron Mike Tyson. But as a follow-up on the sports...
Bold.
Yes, he still got it, I think. But as a follow-up to the sports question for Ted, as you continue to scale Netflix and become bigger and bigger and potentially gain more leverage, how could your sports strategy change beyond what you're doing today around primarily sports entertainment?
Yeah, we've said this many times, but not anti-sports, but pro-profitable growth, and I think that's the core of everything we do in all kinds of programming, including sports. So, our North Star is to grow engagement, revenue, and profit, and if we find opportunities we could drive all three of those, we will do that across an increasingly wide variety of quality entertainment. So when and if those opportunities arrive, that we can come in and do that, which we feel like we did in our deal with WWE. If we can repeat those dynamics in other things, including sports, we'll look at them for sure. So I think we've had the benefit of building an enormous business without a loss leader. And we continue to believe that we can grow on that path, just as you've seen. So I think the core of it is that we're going to look at those opportunities with the same discipline that we do when we talk to movie producers and television networks about putting our content on the air.
Great. The next question comes from Rich Greenfield from Lightshed about our film strategy. So for Ted, a recent New York Times article cited internal communications from new Netflix film chief Dan Lin stating, quote, "The aim is to make Netflix's movies better, cheaper, and less frequent. Lin wants his team to become more aggressive producers, developing their own material rather than waiting for projects from producers and agents that come to them," unquote. Everyone wants to make better, cheaper films, but we find it hard to believe, we being rich, find it hard to believe that there is a magic formula. Help us understand the strategy shift under Dan Lin versus Scott Stuber.
Well, thanks for that question, Rich. I would send you back to that New York Times article because that was not a quote from Dan. And I would say that, and nor did we participate in that article. I would say, just to be clear, there is no appetite to make fewer films, but there is an unlimited appetite to make better films always. Even though we have made and we are making great films, we want to make them better, of course. We're super excited to have Dan join the company. He just joined a couple of weeks ago, and he's joined us running 100 miles an hour. Bella has said this publicly, that our strategy remains variety and quality, and she's doing an amazing job of bringing new, fresh thinking to our content and our content organization. Bringing Dan on board is a great example of that. We want to have a lot of movies. We want them to thrill our audiences, and they all have different tastes, and we want them all to be great. So we take a very audience-centric view of what quality is, and Dan knows that from having produced for us. As the CEO of Rideback, he produced the Oscar-nominated film The Two Popes for us. He did Avatar: The Last Airbender for us recently. So he understands Netflix and the audience really, really well. And his success in live action and animation is very hard to find in the business. So we're thrilled he's doing it here.
Great, thank you, Ted. The next question comes from Kanan Venkateshwar from Barclays. Could you please provide an update on engagement trends now that paid sharing is mostly behind you? So I'll kick it over to Ted first, and Greg, you can feel free to add on.
Well, look, it's important to note that we compete for every hour of viewing all the time, every day, everywhere we operate. And we think that engagement report is very important, and that metric's important because, again, it's the best indicator of customer satisfaction. I know I just said this 10 minutes ago, but I'm going to repeat it. 8 of the first 11 weeks of this year, we've had the #1 movie, and 9 of the last 11 weeks of this year, we've had the #1 series. And that's according to the Nielsen streaming data. And for us, that is what we're singularly focused on. And we've actually seen in that Nielsen data our share tick up a little bit, even in this incredibly competitive space where you've got a lot of folks competing for attention, for time, and for money.
Yeah, Ted, I think you can repeat that 8 of 11, 9 of 11 as many times as you want, as far as I'm concerned.
I'm going to close with it too.
So, as we have said, due to the work that we've been doing on password sharing, we're essentially cutting off some viewers who are not payers, and therefore we're going to lose some viewing associated with that. So when you see our next engagement report, you are going to see some impact to our overall absolute view hours as a result of that. But despite that impact, and despite the general pressure from strong competition that Ted noted, we think our engagement remains healthy. You can see it in the stat that Ted indicated in terms of the Nielsen ratings and our modest growth in TV time in the United States. But we also wanted to do an apples to apples view of engagement. So we looked at the population non-impacted by paid sharing, what we called owner households. And in Q1 of 24, the hours viewed per account were steady with the year ago quarter. So that's a pretty good sign that our engagement's holding up, and it sort of cuts through the noise around paid sharing. And again, I just want to reiterate, we think we got plenty of room to grow engagement, right? We're still less than 10% of TV hours, even in our most mature markets. So there's tons of room of growth ahead of us.
Thank you, Ted and Greg. I'm going to move us along now to a series of questions around plans and pricing strategy. So from Steve K. Hall from Wells Fargo.
Have you noticed every time they
Greg,
change
as
the
you
camera,
continue to expand,
it
do you think there is
pixelates?
a
I want to
ceiling,
comment on that
for
later on.
pricing? If so, how close are
Just
we
watch.
to that ceiling in mature markets? And do you envision Netflix having content tiers so that you can continue to expand your content genres and further segment your customer base?
Yeah, we don't have a set
Do you see
position
that?
on a ceiling.
When it
I'm sure you can look at
transitions, it
KTV as
pixelates.
potential markers for where people have spent before, but we really actually don't think of it so much as defined by that. We see it as an opportunity to continue the process that we've been working on, which is let's continue to try and invest wisely, add more entertainment value, and as we add more entertainment value, then of course we can go back to our subscribers and ask them to pay a little bit more to keep that virtuous cycle moving. And really the markers for us in terms of the upside potential more are around, the hours on TV that we are winning, how many moments of truth we call it that we are winning. Again, less than 10% in our even most mature markets. There's tons of room there. You can use total consumer spend on entertainment in the markets and categories that we compete in. That's, between 5 and 6%. So there's just a lot of runway still ahead of us to go do a good job at making that investment happen, deliver more value, and then, ask folks to pay a little bit more.
Great. Next question on pricing comes from Marc of Bernstein. Can you please share progress on how the retirement of the basic plan is going in the UK and Canada? And is there any color you can share on when we could expect a similar rollout in the US? Greg, why don't you take that one?
Yep. As we shared in the Q4 23 letter, we were planning on retiring our basic plan in some of our ads countries. We've now started that process in Canada and the UK. And very similar to what you saw us do with paid sharing, we're going to work hard to make this a smooth transition. Part of that is listening to our members before we make any further moves. So we've got nothing, more to announce, and we really want to see how this goes. Yeah, and we know that this is a change for our basic members, but we think we've got a strong offering for them. They're going to get, more for less, 2 streams versus 1. We've got higher definition. We've got downloads, all at a lower price. And of course, it goes without saying, hopefully that members can always choose our ads free plans as well if they prefer.
Great. Thank you, Greg. Couple questions on overall capital allocation. So these would be for Spence, primarily from John Blackledge of TD Cowen. Excuse me. You mentioned evolving capital allocation strategy in your investor letter with your new investment grade status. Can you please talk about the changes and how investors will see that change?
Yeah, sure. Thanks for the question. It's really good. It's really quite a modest evolution of our capital allocation strategy to better reflect our investment grade status, and that's really what it is. It's we're still going to have the same financial policies and principles in terms of prioritizing profitable growth by reinvesting in our core business, maintaining a healthy balance sheet with ample liquidity, and returning excess cash beyond several $billion on the balance sheet of minimum cash and anything that we use for selective M&A to return to shareholders through share repurchase. So really the only change is that now that we're solidly investment grade, we're going to, while we will hold still several $billion of cash on the balance sheet, we won't have the same marker of 2 months of revenue, the equivalent of 2 months of revenue on the balance sheet. So it allows us to be a bit more efficient there. We also upsized our revolver, which was announced today, up to $3 billion from $1 billion, which also gives us more access to capital and better cash efficiency. And then again, any cash beyond that will return to shareholders. We've historically been mostly a build versus buy company with select strategic kind of acceleration through M&A, and that there's nothing right now planned, but that still is kind of our philosophy, is to build predominantly. We're also going to kind of refinance our existing kind of debt as those maturities approach, but we don't plan to kind of lever up through stock buyback. We really do value that balance sheet flexibility.
Great. Thank you, Spence. Last question on capital allocation for you. This comes from Vikram of Baird. What are your latest thoughts on the appropriate level of content spend for the business beyond 2024? Specifically, in the past, you have referenced a 1.1 cash content spend to amortization ratio. Is that still the case? And what would you need to see in an opportunity to meaningfully exceed that framework?
It still holds. So we're still basically, the short of it is we're really kind of managing to that. So as we said, we've been focused on driving that acceleration of our revenue growth, continuing to grow our business, grow our profitability. As we do that, we would expect to continue to grow our content investment as we have historically into the highest impact areas, but also be quite disciplined there. So we want to grow our free cash flow. So we believe we can manage to that roughly 1.1x of cash content spend relative to expense on the P&L, and that leads to overall revenue growth, increased profit margins, growing free cash flow. And that still gives us a lot of opportunity to spend into the, all those kind of content and entertainment categories that Greg and Ted have been talking about.
Thanks, Spence. We have a few more minutes left, so we'll wrap up with a few higher level questions. The next one comes from Eric Sheridan of Goldman Sachs. And I think both Ted and Greg can tackle this one. The question is, what are your thoughts on the competitive impact from short form video consumption?
So I look at how what people watch and when they watch it have a lot to do with one another. What are the choices and how much time do they have? So our version of short form is more like giving our members the ability to watch 10 minutes of an episode of a series that they're binging right now if they only have 10 minutes. But some, and also when I look at the short form viewing on YouTube and TikTok, some of it is adjacent and quite complementary to our viewing. So our trailers or creators expressing their fandom for our shows, like posting a Wednesday dance or ugly crying, watching one day, all those kind of things that become viral sensations and actually increase the fandom of our shows. Now, that being said, some of that viewing is directly competitive with us, the same as it is with other media companies who provide content to YouTube by way of example. The art of this has always been finding the right balance of both. And also would point out that these platforms have been a way to have new voices emerge, and we've got our eye on them as well to try to develop them into the next generation of great storytellers on Netflix.
Great. And I think for our final question, we'll take that from Dan Salmon of New Street Research. What is the opportunity for Netflix to leverage generative AI technology in the near and long term? What do you think great storytellers should be focused on as this technology continues to emerge quickly? I'll turn that over to Greg, please.
Yeah, worth noting, I think that we've been leveraging advanced technologies like ML for almost 2 decades. These technologies are the foundation for our recommendation systems that help us find, these largest audiences for our titles and deliver the most satisfaction for our members. So we're excited to continue to involve and improve those systems as new technologies emerge and are developed. And we also think we're well positioned to be in the vanguard of adoption and application of those new approaches from our just general capabilities that we've developed and how we've already developed systems that do all these things. We also think that we have the opportunity to develop and deliver new tools to creators to allow them to tell their stories in even more compelling ways. That's great for them. It's great for the stories, and it's great for our members. And what should storytellers be focused on? I think storytellers should be focused on great storytelling. It is incredibly hard and incredibly complex to deliver thrilling stories through film, through series, through games. And storytellers have a unique and critical role in making that happen. And we don't see that changing.
Great. Thank you very much, Greg. And we are now out of time. So I want to thank you all for taking the time to listen into our earnings call. We look forward to speaking with you all next quarter. Thank you.
There we go. There was the Netflix earnings. What do you think of that? All right. I just wanted to mention, I don't know if anybody even noticed it, but it happens every time. Netflix are a TV company. They make movies, they make live streaming and all the rest of it. So if anybody knows about camera techniques and streaming, then it's them. But do you always notice every time they stream, they make some fundamental mistakes? They're using a very, very low-end mixer. So every time they change from one camera angle like this to another, you see how there's no transition for me? You see how smooth that is, right? It doesn't pixelate. It looks perfect. And they would probably have their own servers and their own dedicated systems, and yet I'm using a domestic internet connection and I've got a better service. Their camera angles are above them and they're looking up at the camera rather than down. So they're always looking under their chin. They've got no field of definition. They're against a wooden board. It's incredible, actually, to me, that they... It's great that they do an interview where they'll present themselves, but their earnings is not like any other. You don't see all the figures. You don't see any of that. They just have a conversation promoting their business. It's quite funny, really, that they are a huge publicly traded company, and yet they've no idea how to stream, and their equipment is ridiculous. I beyond words. But there you go. It's Netflix. They obviously can't afford a studio like mine, and I'm just a guy on YouTube. Quite funny, really, isn't it? Anyway, I just thought I'd chat with you. What is that? What does Omid say? Average down, but it keeps bleeding. Okay, Martyn Lucas, couple therapist. Martyn Lucas, couple therapist. What's all that about? He didn't answer the question. A lot of that was scripted, by the way. They were just saying stuff off script. Yeah. Anyway, there you go. I've just got some terrible news from Virgin Galactic. Unbelievable news from Virgin Galactic. I'm going to make a video now. Stick around. I'm going to do it very, very quickly. I'm not going to hang around for very long, but I'm going to make a video which, to me, is beyond comprehension. I'm about to share with you the worst story I've seen out of Virgin Galactic. Let's look at it. I didn't ever want to report this, but we're going to have to do it. And they did it to themselves. They did it to themselves. So, SPCE at end. SPCE end. Production. Right. Here it is. Virgin Galactic. How did it come to this? Let's have a look. No, it's not that. It's worse than that. Okay. Let's have a look at it. Right. Yes, BTC halving. All right, let's make this Virgin Galactic video. Breaking news here on Martyn Lucas Investor, Virgin Galactic. The video I thought I would never make, but it looks like I'm going to have to make it. Virgin Galactic started out with so much promise. It was the stock that started my channel. It got me excited. Many years ago, I worked for this gentleman, Sir Richard Branson. Richard turned around recently and said he is no longer going to support the stock. He's not going to buy any more shares. And that day, effectively, the door didn't open, but it closed on Virgin Galactic. Got an announcement now directly from Virgin Galactic, an announcement that has just come out minutes ago. I cannot believe they're doing this. It just confirms to me there's something going on with Virgin Galactic. They've got no intention of ever getting behind the stock price. They purposely want to drive it down, but if you drive it down this low, we know what happens. We've seen it with Virgin Brands before. Virgin Orbit went down the toilet, and Virgin Galactic is really now on the brink. I put out a couple of days ago, for the first time in months, that I was bullish. We saw something that was bullish. It was beating the market. It was doing better than the market. That was good. Despite all the concerns we've got with the market, things were looking good. But now tonight, Virgin Galactic again have done this to themselves. They're not putting on a flight. They're not trying to promote the stock. They're not trying to get a celebrity on board. They have the best space company in the world. No competition for now, but that's about to change. Competition is just around the corner, and Virgin Galactic will never catch up and hold this position again. Great shame. What am I talking about? Well, the worst thing that could possibly happen to Virgin Galactic is happening on purpose months ahead of when it actually would even need to happen. But Virgin Galactic, in their wisdom, think it's the right thing to do. It's the right thing to drive the stock price down. It's good for them. They pay themselves in shares. It's rubbish for you as a shareholder. You should be furious now. You should be angry. You should be calling for Eric to be fired. We've said it over and over again. What am I talking about? Well, look, let me share with you some information. We're seeing ratings go to sell at 97 cents. Let's remind ourselves that we are now more than 50% under the cash value of the company. 50% under the cash value of the company. You can buy the company today in its entirety for the value of half the cash on the books. Absolutely ridiculous. But that doesn't matter. That is not as bad as it gets. That's not important. Don't worry about that. Let's make it even more worthless, shall we? Well, what are we going to do? As you can see now, we've got sell ratings from analysts all over the board. The stock's getting lower levels. It makes no sense. That isn't the bad news. This is the bad news. This has just come out. A statement from Virgin Galactic just posted for June the 12th. Yep, you heard me right. 2 months from now. 2 whole months from now, Virgin Galactic have already decided to reverse stock split the company. That is ridiculous. You are trying to destroy the company. Here it is on amendment number 5 to approve amendments to our certification, our certificate of incorporation, to effect a reverse stock split. Reverse stock splits 99 times out of 100 end in bankruptcy. It is a thing that you never ever want to do. Forward split is great. That's when the company is growing and you want to make the stock appear appear is the key word, appear cheaper, so more people can do options trading. Remember, 100 shares make a contract. More people can do options and more people can buy contracts. A forward split is success. A reverse split is being done to remain on the index. They've only been under the $1, which is the threshold to do this, for a few days, and they've already decided to give up and do a reverse split. Where the hell is the backbone for Virgin Galactic? Where is the get up and go, get the bloody thing advertised, get rid of Eric Kearney, get rid of Michael Colglazier, sort out the marketing, do the thing properly, get a celebrity on the flight. It's good enough for Ferrari. It's good enough for Rolex. It's good enough for all premium other brands, but Virgin Galactic feel they are above that. So what do? They devalue the stock even more and then destroy a company on purpose. Look at this and wait for it. How bad do you think the reverse split is? Between 1 for 2 and 1 for 20. This is the sort of thing that has been actioned by Mullen. Scam stocks, rubbish stocks, not great companies or great products like Virgin Galactic is. It's a product. It's not a company. The company is trash, rubbish. The management is trash, rubbish. Eric Kearney should be fired. Michael Colglazier should be fired. This is absolutely ridiculous. The stock price has just gone below $1 a couple of days ago, and it was beating the market. I came on and made a bullish statement and said, this is bullish. And what do they do in return? They give up. They give up before they even get started and go, we're going to reverse stock split. We're not even going to try to remain. We're not even going to try to advertise. We're not going to try to get the stock price up. It doesn't matter. We're not going to put on a flight when we thought they were. We're not going to bother with any of those things. We're just going to go straight to a reverse split immediately. What do you think of this? Leave me your thoughts in the comment. Look at the comments from the shareholders. Fire Eric. Investor relations, 95% of you on a poll we ran on X said fire Eric Kearney. This is a publicly traded company owned by the public who have no say whatsoever. John Granfor, fire Eric. Rigidity, laughing, what a flipping joke. Markets will sell off tomorrow and overreact. Radiant smile, fire Eric. Look at that. Unbelievable. Fire Eric. That's what you think. I am extremely disappointed this evening. I think this is the worst possible news. I would imagine that the board has gone bonkers tonight. Everybody is shouting at each other. What are they doing? Or maybe they're simply asleep. They don't care. Richard Branson has packed his bags. He's not interested anymore. And I'm telling you right now, without a shadow of a doubt, Virgin Galactic is coming into land. This is a very, very sad day. A company that doesn't need to reverse split is planning on doing it ahead of time. That might be the last time that you see Virgin Galactic land. Absolutely awful. Awful. Cannot believe it. We built this studio all around Virgin Galactic. We got behind it. They rejected the investors. They said the investors weren't important. They rejected me helping the company, marketing for them, promoting them, doing anything. They rejected for me to go live on flight days with extra information to promote the stock. Eric Kearney called me 5 times. The last time, the 6th time, I said, forget it, you're wasting my time. He was more interested in GameStop, shorting stocks, and all the rest of it. The company is no longer, in my mind, a company at all. It was set up to drive the stock price down and get Richard Branson his own private flight into space. I'm so disappointed. So disappointed. There are many of my friends who own this stock, and they have got the chance of getting their money out now is near impossible. Near impossible. The odds of a stock at this price in the current climate, reverse stock splitting, the chance of survival now, I wouldn't even give 1%. And yesterday I was bullish. Yesterday I was going, do you know what? They just might turn it around. Not because they know what they're doing, because they don't. They're rubbish. But the investor was holding on and it was beating the market. And that was a bullish signal. And now we get this. I can't believe it. Crag has just meant a comment. They know exactly what they are doing. Reverse split. Then they are going to dilute again on the news. Dilute again. The shareholder will get nothing. They will get everything. This is my prediction for Virgin Galactic. The retail investor bought into a company that we believe was sexy, fun, rock and roll. It got Richard Branson a free flight into space. He should be disgraced today. I should go as far as saying he should have his knighthood taken away. This is disrespectful to people that believed in him, believed in the company. He's walked all over the retail investor. Eric Kearney, Michael Cole-Glazier clearly want to dilute the stock so shareholders give up. This is what will happen. The stock will go private. The technology will be replaced and bought out, and it won't be around. It won't be around for long. This technology can be replaced. Anyone can now compete and take over this. Anyone could buy out this company. It's virtually worthless. That signal has essentially told me the stock is going to under 50 cents a share. It's trash value. What will 50 cents a share mean? Well, right now you can buy the whole company for 377 million. Tomorrow we could be at 250 million. 250 million. It's worthless. A rocket company with customers ready to fly on purpose has become worthless. I can't believe it. People have got behind this company, got behind Richard Branson, and now it's worthless. Leave me your thoughts below in the comments. What do you think? Do you agree with me? Do you agree that the stock price, this is going to zero? Do you agree with me it's going private? Let me know your thoughts. Click above my head, down below in the description, over here and over here. You heard it first here on the day after I said it was bullish. I was hopeful for this stock. I've given it every single thing I've got, and yet the company do not care about itself. They want to drive it private. They don't. That's now explains why they didn't want me to market and help and promote. They don't want the stock price to go up. They don't want you to buy it. They want it to go for a song so it can be taken over privately. Unbelievable. Until next time, take care of yourselves and each other. Honestly, I'm really, really upset. Not for me, for you, the investor, those that are still in on the stock with nowhere to go. Richard Branson, this is disgusting. Till next time, take care. I'll put that out as a video. Check in the mail. Fire Eric. I am disappointed in Eric. Fire that prat, Michael Cole-Glazier. Fire Michael. They know exactly what they're doing because there is too many investors outstanding now for any big movement. Martyn, I thought you were going to part with this company months ago. It's rubbish, clearly. I have parted with it. I'm not in it. I hold it on my wife's account, of course. I've told you that. But I'm not in it on the show here. I feel sorry for the long-term space holder. Eric, a big disappointment for the human race. Richard Branson should have his knighthood taken away. This was the future of space has been trashed. Check in the mail, Martyn. Did they do this to get more investors? Richard Branson should have his private island taken away and given to space long stock holders. Agree, James, he is a disgrace. It's Cole-Glazier's call to do this, but Branson should step in. Fire Eric. All right, guys, I'm going to put this video out now. So I'm going to end the show, get Netflix put up, and I'm going to put this out. What a terrible, terrible day. All right, guys, I'm going to send you over now to the extra channel. Follow me over there, and I'm going to put this video out. I can't believe that. Can't believe it. It was always there, though, wasn't it? It was on the wall the entire time. We tried to ignore it, but they determined to drive it down. All right, I'll see you back in a minute. Space will... yeah, of course it will. You got a reverse split. You've got a devaluation. Get out. The stock's going to go down. Yeah. All right, guys. I'll put the video out, and I'll be over on the extra channel. I feel so frustrated. This is just terrible. All right. See you back in a minute. Join me on the extra channel. I'll get to work. Bye-bye for now.